All right, let's get our first expert in then. Vikas Khemani, Executive Vice President and Head of Institutional Equities at Edelweiss, now joins in. Vikas, hi, morning. Really good to have you on the show. And, maybe you'll be the best placed person to tell us what's happening in the market. Yesterday, we had institutional favorite stocks like HDFC and HDFC Bank falling close to 10%. And today, that's continued. Since, you had the institutional desk and talked to a lot of these institutions, what exactly is happening? Is there a bit of a panic situation and a bit of a give up on India?
I think there is a sort of capitulation happening. Some of the we've seen some of the FIs coming and selling in some of the large cap names. But what happens is typically when this kind of situation is there, you end up selling what you could sell. And I think the names which you mentioned are the most liquid and large cap names, and they could be sold easily. With obviously with the price impact, but at least they could be sold. So I think that is what we've been seeing, and some of the FIs who either got redemption pressure or are wanting to create cash, sensing that this kind of deteriorate further, I think are sort of taking some money off the table, and which is what we have seen. And I think it looks like that we are in a perfect storm right now. Rupee is definitely in a free fall mood, and it's not sort of stopping at, and government is sort of being ineffective on that. You have oil hitting new high or whatever highs, and which is also creating big problem for India. So I think interest rates are going up, growth is slowing down. So I think whatever possible could go wrong seems to be going wrong, whether it is in our control or not in our control. So I think in that sense it is sort of a perfect storm hitting India, and I think we need some strong actions, tough measures for any FI mood to be reversed, which is unlikely to happen in a hurry. So that's the reason I think people who are sort of been in the market for long and hoping that things will improve are sort of taking some money off, and I think creating some cash.
Indeed, Vikas, but at the end of the day, we know what the government will do, because now it's an election year. Just, with the rupee at such a lower level, they went out and still cleared the food security bill in Lok Sabha. So right now, obviously, maybe the market is their least priority. So the question is that, we've got $12 billion from FIIs this year. I mean, about $500 million has gone out over the last 10 days or so. Going forward, do you see the possibility of maybe $2 to $3 billion going out? And does this market have the ability to absorb that kind of selling?
No, first of all, I think I would disagree with you that market can be least priority. It's not about market. I think it's about economy. And market is only a mere reflection of the economy. So I think government has to be worried about economy. What would be the economic implications of whatever is happening all around on a macro basis? And the cost of that are very severe. If it continues to remain like this, we might see wide scale systemic problems getting created, accentuated further. And I think so. Hence, it is important that it sort of gets stalled here. And I think some concrete measures, even if they are tough, and which I know that in an election year it is difficult to take, but that needs to be taken. So I think it has to be, in my opinion. Unfortunately, it's not sort of coming out, and I think I'm sure they have been sort of working at it, but so far it has been ineffective. So it's very difficult to say that how would what actions they would take to sort of improve market from here. But I think so market, it's not about focus on the market, it has to be focused on the economic factors, which has a lot more implications.
Vikas, hi, morning. I know it's difficult to push something in this market, but if you are recommending an idea to clients, what would it be?
Cash. So because I think best thing is, in my opinion, especially things are falling apart, it's better to sit on cash. I mean, risk management, and I think is the most important thing according to me, because I think when you are in the middle of a crisis, it can keep on degenerating, and we have seen in 2008 how when the final moment of capitulation comes, then everybody turns bearish. But I think currently, in my opinion, I would tend to think that still sitting on cash and not preempting any buying in the market would be the best possible solution. Even if, let's say, improvement comes, or let's say things start stabilizing, markets are unlikely to go up in a hurry. So you will get a time of consolidation. You will get a better time when you will be able to make much more rational decision with much more calmer mind than in a state of panic. Right now, markets are in a state of panic, and I would say that if there are no strong measures being taken, and I think it's been the situation for now 6-9 months, so it can happen another 3 to 6 months, then market can really degenerate. We have seen markets coming from 6,000 levels to 2,800 levels. I am not suggesting that it's going there, but I am saying, and that time also arguments were very much there, like that can it fall further from here throughout this this journey, but market kept on falling further. So one is one cannot put any sort of level to decide that this is the bottom where you can start bottom fishing. So according to me, preempting market is not a best idea in a situation like this.
Okay, Vikas, just focusing on the point that you brought up about the economy and the fact that the market is reflecting that, we have a GDP figure which is coming out on Friday, but are FIIs worried about a further downgrade to GDP, possibly in the next 2 quarters?
No, I think definitely, because no number suggests that, we are looking for an uptick. So in fact, most of the investors are getting pessimistic about, future numbers. And, if there's a upward surprise, market will definitely cheer in short term, I do feel. But, I think most market participants and investors, I think, believe that we will see a downtick in the number. And I think we've seen IIP number consistently dropping. We have seen interest rate remaining high. So I think there's no case for GDP sort of to go up. I think only hope probably the good monsoon which can give some respite, but I think that is unlikely to figure out now. So I think agriculture seems to be the only hope at this point in time. So sure. I would say that still there are no optimistic sort of indicators about GDP growth to look up or look better.
All right, the market is pulling back a bit, and it's a fair pullback. If you see, the Sensex was down 500, it's now down 250. What's happening is banks are seeing some buying interest from lower levels. Not to say that banks have turned in the green or there's quite a bit of buying that's happening right now. Nothing like that. But from 8,400, the bank nifty has gone up to 8,600. If you see HDFC Bank and ICICI Bank, these are the two stocks that have risen about close to 2% from their intraday lows. Look at HDFC Bank. There's a bit of an uptick that you've seen, 1.8% lower now. It was 4% lower. ICICI Bank was 4% lower. It's now 2% lower. So there is a bit of buying that's happening right now. Because I come back to banking, especially the private sector banks, because that is what's deciding the market right now. I mean, of course, IT is still holding firm, but what's really broken the markets back is this private sector financials. Do you sense that there could be some bottom fishing around these levels on an ICICI, on an HDFC Bank, on an IDFC maybe, would you steer clear of that?
See, look, I think my answer remains same. Currently, there are two kind of objectives. You have a trading objective and your investment objective from medium to long term perspective. I would say that trading objective might get served by doing a little bit of short term trading, play pullbacks. I don't know how to do that, and that's very difficult to do that, and there are experts good at that. But I do feel that even in the banking sector, I think doing bottom fishing from an investment perspective may not be the best idea, given the fact that I think asset quality issues are unlikely to get sorted out anytime in a hurry, and it's directly linked to the GDP growth, and I think GDP growth unlikely to improve, IIP numbers are unlikely to improve, interest rates are unlikely to come down immediately. So I do feel that unlike one should not preempt right now. We will see this quarterly numbers coming out, which could be sort of worse than market expectation, and so you might get better levels. I don't think it's a time to sort of look at that. Some of the name, if you have to buy, some of the names like HDFC Bank, ING, Vaishya Bank, where asset quality issues are sort of slightly lower than peers, you might look at them, but they are so But again, I would say that. Better from banking perspective and banking sector, better to wait and watch rather than preempting them.
Well, we have specific declines which are coming into the markets today, and it is definitely secular at this point. Asian Paints is currently down around 8% and remember ITC2 is just barely in the green on a YTD basis. So maybe there is some amount of trepidation which is seeping into these consumption theories as well. What is your view, Vikas, in terms of these urban consumption themes? Is that something which you'd be worried about? Not the rural economy, but urban consumption themes such as Asian Paints. And would it be an opportunity to nibble into a couple of these stocks at current valuations?
See, nothing great has changed in the valuations. Still, they remain expensive. But I think one thing, as you rightly said, that I think the urban consumption has been, slowing down, and that's likely to continue. And I think, to some extent, you might see a slowdown in the demand. But, it's not that, it will be only a slowdown in demand. It's not going to be a big time negative, growth, or, the balance sheets are, fairly decent. So I think it will be only slowdown of the profitability. So probably, I would say that, of course, consumer stocks will not go out of the limelight in times like this. Consumer, pharma, IT, these are the defensives. I think they will continue to see sort of buying at the lower level. Currently, reason why you are seeing any sharp falls in some of these stocks is because I think investors who are getting redemptions and wanting to sort of reduce some exposure, I think these are the names which could be sold off. A, they are expensive, and B, I think they're easy to sell. So I think these could at least be sold. If somebody is there to sell, there are buyers as well. But in some of the high beta names, buyers are sort of not there, so it's difficult to sell. So I think one of the reasons why if there is redemption, these counters can be sold, and hence you are seeing correction. So I would say that I think more expensiveness of these counters and some of the redemptions is taking a toll on them.
All right, Vikas, thanks a lot for your time, and thanks for talking to us. That's of course the view from Edelweiss. Their sense is no point doing any kind of bottom fishing. If the market is in a structural weakness, you don't know where it could go. The point on Asian Paints which Ekta made actually is quite interesting, because down 8% now on Asian Paints. I mean, if you pull out a one-year chart of Asian Paints, actually that would just tell you what's happening in this market, the kind of sector rotation that's been happening. See the kind of rally it had. Now, on 12-month basis, it's still up about 3%, and that's after falling what 30% in recent times. 25% this month alone, Asian Paints has fallen. Still, on a 12-month basis, it's up 3%. That tells you the kind of bipolar nature the market had all through the year, and that trade is now correcting a bit. Let's take a break on that note. Once we come back, we'll get Jayesh Mehta, MD and Country Treasurer of Bank of America, joining us.